Thank you everyone for joining. We'll get started here. Before introducing today's instructor and the topic, just wanted to talk about a few housekeeping items coming up with Mountain West Small Business Finance that we're pleased to announce. The first of which, getting back to doing some in-person events, and we're looking forward to seeing you all. On July 21st, which is a Thursday in the evening, starting at 6:30, Mountain West has rented out Cowabunga Bay, the water park there just off of I-15 in the Sandy Draper area. This is an event where we would love to see everybody and their families there that has any kind of interaction with Mountain West. We're really hoping to see a lot of people there and get summer kicked off right. So that is July 21st at 6:30 p.m. Mountain West has rented out the facility, so it will just be Mountain West employees and clients and friends, and we're looking to see you all there. There'll also be dinner there. And so if you have not received any of the emails, the correspondence with how to register for that event, please just send me a link here quickly in the chat, or you can email me at dmangum@mwsbf.com, and we'll shoot you that email and get you listed there. We'd love to see you and your family members there, significant others. Also coming up later on this summer is the annual Mountain West Golf Tournament, which will be held on August 18th. And that is for individuals who have done a deal with Mountain West in the last 18 months. So be looking for an invite and a save the date there. We're very grateful to Curtis Singleton for offering to put on this training today of advanced eligibility. Curtis has only been with Mountain West for a handful of months, but is very well versed in the industry, having worked at both credit unions and other certified development companies in the state. Curtis is very knowledgeable, and we look forward to hearing from him. I will be monitoring the Q&A and also the chat feature. So if you have any questions, please don't hesitate to hit anything there, and I'll either address them in the chat, or we'll pause Curtis and kind of pose the question at large. So with that, take it away, Curtis.
Sounds good. Thanks, Danny. Nice introduction there. Okay, so we'll focus on advanced eligibility today. This is our 5th session presented by us. Next month, we'll be covering affiliation, which is done by Jeff Fancher. Refinance eligibility, we're not going to do this session. So if you're looking for refinance eligibility, be sure to tune into our September and October. Again, like Danny said, my name's Curtis. I'm one of our loan officers here at Mountain West. I'm thrilled you guys have joined us today. Okay, so we're proud of who we are, what we've accomplished, and we thank you for your continued support. We're the #1 504 lender in Utah, #1 in the region, and top 10 in the nation, which is really pretty cool considering our primary market has been in Utah, and Utah's population is pretty low, so our per capita production in 504 is pretty awesome. We help hundreds of businesses each year. We're leaders and teachers in the industry, and we train other CDCs, but we're always looking to improve our own processes, and I'm sure some of you guys have noticed over the last year or so, we've made some adjustments to how we interact with you and how we are handling our loan process. So advanced eligibility, it's an exhilarating topic. I'm sure everybody is so excited and can't wait. My hope is that after you get done with this, you can't wait to go home and talk to your families and tell them how good this was and how Top Gun Maverick has nothing on this type of content. Okay, so SBA cares about eligibility, and why does it matter? So we care about all the same stuff you do. We care about cash flow, we care about credit history, all of that, but we also have to deal with eligibility. It's kind of a key piece, and credit is, I've always kind of said credit's an art, not a science. So, you know, we may be able to walk through and explain to SBA why historical cash flow is not a concern, or why somebody's past credit history is not going to be an issue, and SBA will take that. It will still meet their SBA mission. But eligibility can often be very inflexible. If they can't meet occupancy, they may have great repayment, but it just doesn't matter. So eligibility is a big deal. Sometimes a loan may be a slam dunk from your own perspective, but it maybe just doesn't fit into the SBA box for one reason or another. Some of them are very random. We want you and your borrower to be happy. So, I mean, in all cases, you know, our relationship with you and your relationship with your borrower is super important to us. Get us involved early, especially if it's not a clean one owner, it's kind of weird. Definitely get us involved as soon as possible. So some things to note as we get going here. These are not in any particular order of importance or of how often we see them. I've just tried to put them together in kind of a way that semi-segues between them. We've tried to identify issues that can derail a project, whether it come before you're submitting to SBA for authorization, but some can even be issues at closing, which is almost worse because you've already funded and you're waiting for the loan to fund. Some of these are pretty obscure, may not run into them very often, but I guarantee you'll run into one of them at least at some point. And as often as possible, I'm going to try and provide some examples, just anecdotes so that you can kind of apply them to what you do in your day. So first place I want to start is credit elsewhere. This is actually one of the more gray areas of eligibility. Essentially, the hard and fast way to look at it is we have to establish that the borrower does not have the ability to obtain the loan on reasonable terms from non-federal, non-state, or non-local government sources without SBA assistance, which is just a really convoluted way of saying we have to make sure we explain to SBA why they can't get SBA financing, why they need it, or why they can't get conventional financing, why they need SBA's help. Our prior training covered the credit elsewhere categories, so I'm not going to go over those. You can actually access those. I think it's MWSBF.com/blog, and you can find last month's and all the other ones as well. So the main catch-all we use for credit elsewhere is the loan being requested by the applicant is not available on reasonable terms from non-federal sources because the overall advance rate exceeds lender's conventional maximum for this type of property, which again is a giant mouthful for LTV too high. So that's generally what happens when you're doing these is, you know, they only want to put 10 or 15% down, and you're not able to do that conventionally. And if we ask the borrower to put more down, it's going to, you know, jeopardize their business cash position. And so we want to try to avoid that. So that is kind of the catch-all we use for credit elsewhere. Thought I'd kind of point out a couple of potential credit elsewhere issues that I've been seeing kind of common recently. And keep in mind, all of this stuff, you can kind of argue with SBA on these sometimes. Sometimes it works, sometimes it doesn't. So if a business has too much cash and a larger down payment to make the loan eligible for conventional financing would not jeopardize the business. In other words, the business individual owners or the business has too much cash, it would not be a strain on them to put more money down, and it could be conventional at that point. Also, if the loan to value ratio is very low, why would the financial institution need SBA support? So I actually have a circumstance I'm working through right now that has this exact issue. So it was a $2 million project cost. It's actually a refinance. It's a loan to a restaurant. They just have a loan outstanding and it's not great terms. So they want to refinance it, no cash out. One of the 5 owners had about $4 million in personal liquidity. So he's got some cash and he's got some stocks and bonds, and SBA does combine those when they do this evaluation. LTV was low at 69. When we submitted to SBA, they determined that it was not eligible because at least one of the 5 owners had sufficient liquidity to reduce the loan balance to a point where SBA said there's no reason why a bank or a credit union wouldn't do this loan, right? And you know, from our perspective, we've resubmitted this to SBA with some explanations and why we think this is okay in this case. And one of them is this restaurant is a very small part of their overall picture. They own like 4 other grocery stores. And so we're kind of going with the, you know, supply chain issues, inflation. These guys want to keep a lot of cash and this restaurant really is just such a small part of what they have. The cash is not available to put down. And so we'll see if it works. If you're interested in knowing if it does work, you want to check in with me in like 2 weeks. I'll let you know. Another credit elsewhere issue that comes up every once in a while is if a borrower purchases a property in cash, but they want to be reimbursed with a 504 loan. Sometimes this is okay, but it is definitely an uphill battle and requires some fine touches from the CDC, from Mountain West. It just depends. So I had one recently where it was a construction company, and they went under contract right before Christmas, and they needed to close it kind of like before the end of the year. And there's just no way any financial institution or the CDC, Mountain West and the SBA and all that, it just wasn't going to happen. And so what they ended up doing was purchasing the property in cash. They had the cash available, but because they're a construction company, it was actually a unique challenge for them because, as most of you know, I mean, construction general contractors, their ability to bond and bid on jobs is dependent on their cash. And so we determined this was okay and proceeded with the loan, and allowed them to kind of replenish that cash, because it would have been tough for them to continue to operate at the level they had been. So just something to keep in mind. Like I said, this doesn't mean it's an absolute no, but it definitely, if you're running into this, I'd recommend calling us and going over it. So next, we've got size standard, another really exciting topic. SBA considers size standard, basically they just want to make sure the business is still small. So there's two ways to look at it. There's the industry size standard, which is often considered the 7A size standard. And it's a chart. You go and you search the NAICS code, and the chart will tell you what size requirements SBA has for that particular industry. Generally, it's employees and gross revenues. That's what you see often. We use typically the alternative size standard. And that is basically you aggregate the borrower, its affiliates, you aggregate the net worth, current net worth, and tangible net worth, and then the net income averaged over the past 2 years. So pretty rare that you'll run into issues where somebody's too big for that, because 15 million is a pretty big business and 5 million is a lot of net income. But keep in mind that SBA does count affiliates in that. So if you've got a guy that perhaps has been very well heeled and he's got 2 or 3 entities that have a lot of history, you can pretty quickly get up to that number if you're not keeping track of it. So again, we aggregate everything. So that's going to be kind of an important piece as you're thinking about that. If they're really big, check with us, have us run some size standard analysis for you. Another thing to note, only tangible net worth counts towards alternative size standard. So if you've got a business that purchased another entity and they've got goodwill or blue sky or whatever showing on their balance sheet, that does not count towards the size standard calculation for alternative. So sometimes that comes up too. Okay, so eligible entity structuring. Some of this is going to be obvious and some of it may be a little bit new. So terms, we've got operating company, which we refer to as the OC, eligible passive company, which we refer to as the EPC or a holding company. Those two you're probably most familiar with. Co-operating companies, it's a circumstance where maybe you've got multiple operating companies. So maybe a guy owns 2 businesses and they're both, operating out of the same building, and maybe you need them both to justify the new building payment you're trying to do. So you can like combine their cash flow and you can kind of look at their whole picture as a global picture. Maybe it's to help justify repayment. Maybe it's just to help meet occupancy. Another co-operating company scenario that works is maybe you've got a building that is split right down the middle, 50-50, and you've got one guy who owns one company and another guy who owns another company, and they want to buy the building. Neither one of them would be meeting the occupancy requirement if they were to try to buy it on their own, but maybe they create an EPC together. Both go in and they become co-operating companies in that particular loan submission to SBA. That would work as well. Guarantor affiliate is the more unique one. It's added to bring strength. Maybe you're using it to try and reduce an injection, or maybe it's because it has more than 20% ownership in your operating company or your holding company. So, excuse me. Entity structuring example. So let's say an OC is buying a building. It's owned 50%. Let's say it's owned 50% by me, and then 50% by an LLC and I have 2 friends that own that LLC. So individual, I sign personally. The LLC that my friends own also signs as a guarantor affiliate. And then any individual or business that owns 20% or more of the guarantor affiliate must also sign. So my 2 friends would also have to sign as personal guarantors. The guarantor affiliate, it can't be used to eliminate cash flow issues, which is, so I can't like combine a guarantor affiliate with an operating company. The operating company or co-operating companies have to be able to stand on their own. So guarantor affiliate, maybe you bring it in for strength because it's a really strong company and it helps kind of make everybody comfortable, but it can't eliminate cash flow issues. Also, a guarantor affiliate can be engaged in non-OC or passive activities, such as leasing investment properties or holding other non-OC related activities as a pass-through. So I have an example of that on this next one here. So this is actually a scenario I had, and I put the guy crying at the bottom because you'll understand. So I had a family, they were looking to purchase an RV park. They created a new entity to run the RV park, which would be our OC. The OC was then owned 100% by a family limited partnership LLC, which in this case would be considered the guarantor affiliate. That family partnership in turn was then owned by 11 family members, of which none was 20% or more owner. So we always have to have somebody guaranteeing. So we required the father to sign because he had some really good personal financial statements and had really kind of been the longest tenured one, and et cetera. Then we had one of the sons sign. He was the CEO and kind of like the brains behind the operation. Dad was pretty uninvolved. Son was really knew what to do. So that's how we had that structured. The family partnership itself had ownership in, like, I don't even know if 30 is enough. I put 30 plus properties because I can't remember how many. There was a lot. They had other mobile home parks. They had RV parks. They had investment properties, residential homes. I mean, it was just a mess of stuff. So imagine the tax return on that one. And so we were able to make that eligible. It's eligible. And I'm already bald, but I lost some hair through trying to put that one together too. It's complex, it's difficult, but it can be done. So just keep that in mind. If you're running into those, hopefully you don't run into them very often, but it can be done. Okay, so occupancy and leasing, these first 2 bullet points, pretty much everybody's familiar with for the most part. So 5149, occupancy, if you're purchasing a building, if you are constructing, the applicant must occupy 60%. One of the things we run into every once in a while is a lot of us forget that there's not a period after that 60%. There's other things that you have to consider. So for example, they've got to build it. They can permanently lease 20%. So 10,000 square foot building, they have to occupy 6,000. They can forever and ever lease out 2,000 square feet. The other 20% that's left over, they can lease temporarily with the intention of using some of the additional 20% within 3 years and all of it within 10 years. Now, intent is kind of an open-ended word. So it's pretty open-ended on the positive side, but like, for example, I have this example down here in it. So say a business, they construct a 2-unit building. They've got 60% on one side, 40% on the other. Our business moves into the 60%. That's great. And then they lease the other side out with a 5 or a 10-year lease to a third party. You'd not be able to establish that you have the intention of occupying that other 20% space because you've got a 5 or a 10-year lease in there. So at the end of the day, the borrower would be out of compliance in a circumstance like that. If the lease was in place before the 504 debenture actually got funded, that would actually cause an issue with funding. We'd have to fix that problem before we could even fund the debenture. So that one could be a big issue if you're super concerned about a particular scenario. If it happens after the debenture funds, borrower's still out of compliance, and it's basically just like a no-no. The borrower wouldn't be able to obtain additional SBA funding until they had that particular project back in compliance or the loan's paid off, the SBA portion was paid off. So keep that in mind as you're evaluating construction projects. It's not just 60% occupancy period. There's 2 other things to consider in there as well. Okay, more occupancy and leasing. This one's always kind of fun. The holding company must lease 100% of the rentable property to the applicant, small business. So EPC has to lease 100% to the OC, and then the OC can then sublease to the third-party tenants if they have other tenants. I'm not exactly sure why SBA does that, but it's just what they do, so we just follow the rules. So when we actually go to closing, that's what we require as part of our lease and occupancy stuff. Also, generally, closing and funding of the 504 loan should not take place until the operating company is occupying the requisite amount of space. However, there are circumstances where that may not be an issue. So my example in this is a business, they purchase a building. There's a tenant in there right now that's occupying the space. They have 3 months left on their lease and they'll be leaving after that. That's okay. Like you have up to a year to meet that occupancy requirement. So in no case, we have to be able to establish that when we submit it to SBA, that the borrower can get in, occupy the building within a year. Okay, more occupancy and leasing. So rent or lease payments from the OC, this one is coming up more and more often. This is like super common now and really frustrating, but it is what it is. So basically SBA says the OC can't pay too much rent to the EPC. So they basically have it limited to the loan payments on the building, taxes, anything direct expense related, taxes, utilities, insurance, maintenance, anything that property management, those things can be added in. So basically SBA kind of wants to see that number as close to zero as possible on the net income part of an EPC. SBA, they just don't care about market rates. I've tried to make that argument before in the past, and SBA they just don't care. So market rates don't matter. It's kind of the way they just have it. So this also applies to prior SBA loans. So for example, this is actually a scenario I'm working with now, of course. I have a borrower, they have an old 504 loan that they did a couple of years back. We're doing a new one for them right now. As I was evaluating going through the loan, I discovered that, so they've got an old one and they're expanding. Their old one is under a different holding company than the new one we're doing. So the other holding company would be what we call an affiliate. So that affiliate, I evaluated, looked at it. It's an EPC for our other 504 loan. They had 170,000 in net income and like 170,000 distribution. So they'd taken some cash out. So what that immediately told me was, it's probably considered excessive rent. So I have to fix that before I can go to SBA with my other loan, because SBA will not approve it. They'll want me to certify that the other loan is in occupants, is meeting the occupancy requirements and that they're in compliance. And in this case, they probably wouldn't be. So we've had to work through that. So how we work through that, we have to correct the excessive rents issue. So how we do that, borrower writes an explanation, indicates they're going to comply with the requirements going forward. And the important thing is not just that they say sorry, but that they feel sorry. So make sure that as they're writing that letter, they're feeling much better about how they're going to go about doing this from now on. They have to create a new lease, execute the lease, and it meets the new requirements. Sometimes SBA is going to want it recorded. We've seen some kind of inconsistency there. It's usually best if we address it like right up front, like we catch it, not SBA catch it or you catch it. Because if SBA catches it, they're going to be pretty hardcore on how to address it. But if we just kind of get ahead of it, tell SBA, hey, they had a problem, we fixed it, here's what they've done. They usually just kind of gloss over it at that point. So some other EPC rules, occupancy and leasing. An EPC may not engage in any other activities other than leasing to the operating company. So no investment properties, no vacation rentals, no nothing. It's just got to be, the dollars have to come from the OC in terms of if it's going to be an eligible EPC. I actually had this scenario just this week. Borrower they have a property and they bought the parcel right next to it. They bought that other parcel because it gives them better access to the property, gives them just a little bit better, overall, it's just kind of a better situation to have that parcel. It had a residential home on it. And so the owner of the company put his son in there and just lets his son lease it. Well, I've got money coming from something that isn't the OC. And so now that EPC is not eligible. If he wasn't renting it out, probably be fine, but because he's renting it out, SBA is going to say it's not eligible. So in that case, borrower has to like either create a new EPC, just do it for my new loan, or they have to like deed the property out, which is a hassle. So anyways, just that's kind of something to remember on there. Holding companies and other EPCs are considered in size standards. So that $15 million net worth and the $5 million net income, we do have to count that. So we put them all together. So if you've got EPCs that have really high net worth, you could have some size standard considerations to look at. Then I put this in here, EPCs must maintain financial statements. So basically, if we're using an EPC that has historic, they're already have rent and OC properties coming in, they've got to be able to get us interim statements and tax returns and all that stuff. Sometimes guys are like, oh, I don't do, interim statements or any statements until the end of the year. My CPA does it. That won't work. We have to have those. Okay, historic properties, another really fun one. And you'll have to use this next time your kids tell you you're old. Just tell them you're vintage. I think it sounds better. So SBA has to consider whether projects they fund would adversely impact property that is listed or is eligible to be listed on the National Register of Historic Places. So basically what happens if it's over 100 years old, I have to reach out to the State Historic Preservation Office. There's a guy there named Chris Hansen here in Utah. And we have to get a no adverse impact assessment from him. So if it's a straight purchase, they're just buying the property and moving in, it's pretty easy to say that there's no adverse impact to the property. So I send it over to him. He sends me a thing saying, yes, there's no adverse impact, and we're done. If it has renovation, there can be some back and forth with the Historic Preservation Office. I had one last week. They bought something that was 113 years old, finishing buying it now. 113 years old. They were doing some renovation. When I reached out to the State Historic Preservation Office, he wanted to know, are they changing the windows on the front or the door on the front? Borrower said no. State Historic Preservation Officer, Chris, said, fine, I'm good with it. We got it all signed off and good to go. Once the SHPO, that's what we call the historic preservation guy, SHPO, signs off on the no adverse impact to the property, we have to send that to SBA District Council to get their benevolent blessing to proceed with the project. We can't even submit it to SBA for approval until the district office has signed off on it. Super annoying, but it's just something. So if you run into a property and you're aware that it's historic, let us know soon, because we can start that process really early. Generally speaking, if there's no renovation, it's pretty quick. My last one was 2 days to get the whole thing beginning to end done, but I've had some that take 2 weeks. So if you have these, let us know. It's important that we know that it's historic, if it is. Okay, business acquisitions, another fun one. So anytime our business is purchasing a property from a seller that's in the same industry, SBA is going to call it a business acquisition. And that's even if they're not buying goodwill or inventory or anything. They're just buying the building, still counts as a business acquisition to SBA. So for example, if our borrower is a used car dealer and they're purchasing real estate that's owned and operated by another used car dealer, even if no inventory and goodwill is being purchased, SBA is still going to look at that as a business acquisition. And I'll tell you what that requires on the next slide. Another example would be a dentist purchasing a building from another dentist. And this one even is a stretch, but it's just what they do. So if you have like an Asian restaurant and they want to purchase a building that a South American restaurant has historically operated from, SBA is still going to call that a business acquisition. Business acquisitions don't necessarily always require an additional down payment, but it's worth noting because there's a couple of extra steps we have to take. So in these cases, if the seller's serious, they're going to get us 3 years of business tax returns. We have to have those. If they don't have tax returns for some reason, I don't know why they wouldn't, but if they don't, we can take revenue tax receipts. SBA will accept those. Interim financial statements may be appropriate or available depending on the circumstances. And so sometimes considering that in there is a good idea. if they have them, let's get them, kind of a thing. And then the seller has to sign a tax transcript request form, what we call an 8821, which sometimes is, for whatever reason, sometimes kind of a sensitive subject. We don't have to share any of this with the borrower. Seller can send them directly to us. Like, we understand there may be some privacy concerns and whatnot, but all of this can stay between Mountain West and the seller if that's the case. Worth noting, if the items aren't provided to SBA, they won't approve the loan. So if they've decided it's a business acquisition and you don't have this stuff, they'll just send it back to you and say, get me the stuff. Let's see, life insurance, another fun one. So SBA requires, and in some circumstances, life insurance may be needed to mitigate key person risk. We do a calculation based on collateral coverage. So circumstances that are almost certain to require it, 100% owner. If he dies, the thing's done, right? 50-50 spousal owners where maybe one's uninvolved. So, you've got a 50-50 general contractor owned 50% by husband. He has a B100 license. The wife has nothing. She's not even involved in the business. She's a homemaker, but she owns the business with him. That's likely going to need life insurance. Highly qualified professional licenses are another good one. Dentists and doctors, obviously. I just brought up a general contractor is another one. There may be other circumstances that SBA or Mountain West determines may need it. Just kind of depends, but an example is like a non-owner employee of the entity that's crucial to business operations. That may be an area where you have to get it. It's come up before. So basically, the way I look at it, if there's a concern whether a business could continue operating in the event of an owner's death, you probably should be thinking about life insurance, or maybe at least having that conversation with the borrower. That's what we do. So you can get around life insurance. A couple of ways to get around them. If you've got multiple owners that are active in day-to-day management, easy. There may be a minority percentage owner in the business that's not guaranteeing that could potentially take over for a majority percentage owner if they're to pass away. That's sometimes okay. You want a succession plan and such. This one is definitely a hit or miss. Family members with no ownership, they're active in day-to-day management. For example, like a son that's maybe worked in the entity for years and years, but just doesn't have ownership, but they've got a documented succession plan. Sometimes that'll work too. Collateral coverage calculations show no collateral shortfall. So I had a loan last month. Purchase price was $3.2 million. The appraisal came in at $3.7 million. So what we do when we run the life insurance calculations, we take an 85% advance rate of the appraised value. These are SBA's calculations. 85% advance rate on the appraised value. And then from there, we just subtract out the new first lien, the new second lien, et cetera. And then whatever number's left over is what they have to get in life insurance. Well, because the thing appraised for so much more, there was no life insurance, there was no collateral shortfall. So we just told SBA there's no collateral shortfall. Key person risk has been sufficiently mitigated through collateral coverage. He was 100% owner, and SBA accepted that and approved it. So also, if an individual is uninsurable, SBA can't force them to get it. If they're uninsurable, and they're not going to, they can't decline a loan just because the guy's uninsurable. So they have to be able to get a letter stating that, but we can get around it that way as well. Okay. See what time it is, 35. Okay, we'll kind of bust through this. Eligible sources of contribution. So the usual business cash and personal cash. Anytime we're going to use business or personal cash, we have to be able to see that on the balance sheet or on the personal financial statement. It's not good enough to just be like, well, it'll be there by the time they close. We've got to see it. We've got to be able to justify it to SBA. Equity in project real estate is eligible as well. So if they've purchased land within the last 2 years, they want to build on it. We value that at purchase price. So if they've got a loan on it, the difference between the loan and the purchase price would be eligible equity, or if they have it owned free and clear, that would all be equity. If it's been land owned over 2 years, maybe they bought it for $50K a couple years, 10 years ago or something, and now it's worth $400,000. We would value that equity injection based on the as-is appraised value of the land. So, and then this last thing, it's not like anybody really does this anymore, but every once in a while somebody brings it up. If the building appraises for more than the purchase price, the difference is not equity injection. So prepaid expenses directly attributable to the 504 project. That's a common in construction loans. Architect fees, deposits on materials, anything they make out to the general contractor while, the bank and the CDC get their act together to get the loan approved and funded. Those can all be counted towards the borrower's total injection. A personal guarantor HELOC is a great way to do it too. We'll probably notice it when we look at it. We'll call you and be like, hey, where's their down payment coming from? If it's coming from a HELOC, that's totally fine. We just have to make sure we account for that on, whether it be on the personal cash flow side or the business cash flow side. We just have to make sure we address that. And we tell SBA like, hey, we accounted for that HELOC payment. Same exact thing for business line of credit. Eligible sources of borrower contribution. Another one that comes up pretty often is seller financing. We can do seller financing as contribution. It's got to be subordinate to the 504, third position generally. It can't be prepaid without SBA consent. The loan may not have a term that is less than the 504 debenture and cannot demand payment prior to SBA debenture. So if you've got a seller finance loan and our debenture is 25-year debenture, like we like to do now, that seller financing cannot be less than 25 years, and it can't have a balloon either. Now, that is only if the seller takes the project property as collateral. So if they take the property as collateral, they've got to meet those bullet points. If they don't, then it doesn't matter. There's no real estate involved. We just have to account for the payment. We know it's there, but they don't have to meet those requirements above. Okay, these two bullet points are like not great ones to try and go down this. Gifts of down payment are okay, I guess. So gifts of down payment can be eligible. If they're coming from family members, that's often okay. I would say anytime you think a contribution is going to be a gift, where there's no consideration on the back end, I would contact one of us loan officers and just talk to them about it, see what they say and kind of assess it with you. I have in the past suggested adding, when there's a concern about consideration and a gift, adding one of the person who's giving the gift as an owner to the EPC. That's a good way to do it. Doesn't fork it, doesn't hide ownership from the OC or cause any issues there. Other possible sources, which these are very heavy on the maybe. So if you run into these, definitely call us. Leasehold improvements made while leasing a building prior to purchase. So maybe a guy's going to buy the building he's been in for a while and he's recently made some leasehold improvements. Maybe. Home Depot receipts aren't going to cut it. We need good, clear documentation. Rent credits from the seller. This one's you can do it, but SBA's rules for how you do it are just so ridiculous that it's almost not worth doing. So if you're into rent credits where the seller wants to provide credit for historic rents that's towards the down payment, call us. It's probably not going to happen, but we can try. Okay, so just some miscellaneous stuff. Remaining economic life. The appraiser needs to address remaining economic life in the report, and our SBA debenture cannot exceed it. So if you've got a remaining economic life in the appraisal of 20 years, the appraiser says it's got 20 years left, that's not going to be eligible for a 25-year debenture. We can do the 20, but you can't do the 25 unless you're magic and you can call the appraiser and talk him into giving you a 25-year economic life. I've seen it happen. So feasibility studies, I bring this up because on large startup projects, especially storage units, SBA sometimes likes to see a good credible analysis from a qualified party to determine the feasibility of a project. It's easy for us to understand the area and why it makes sense to go in this area or whatnot, but SBA doesn't. And so we have to talk them into it sometimes. So I say qualified party and preferably unbiased because sometimes owners will want to do their own, and sometimes it's okay depending on their past, but a lot of the times it's best to just hire a third party for it. Projects on land leases are super fun. They can be financed. There's unique requirements. The land lease must be fully arm's length. So if you've got a guy leasing land and the company he's leasing from is owned by 4 people, one of those 4 people is his dad, SBA won't do it. It will not be an eligible arm's length lease. I'm actually not sure why somebody heard them in the past or something, but that's just kind of the way they look at those. So that's basically it. This wasn't meant to be all encompassing, but I wanted to address some of the more, typical stuff you might run into that can cause you some problems. For any out of the ordinary circumstances, I'd say definitely reach out to one of us. We want to help you jump in early. We want to help you try and figure it out, and just kind of get through it. We have, do this too. Oops, there we go. Next one is July 28th. It's always on the fourth Thursday of the month. So July 28th, 11 a.m., Jeff Vancherry will be doing affiliation. And we'd love to see you guys come to that. So Danny, do we have any questions or anything?
No, we've been addressing the questions as they've come up. Thank you so much, Curtis, for putting in time and effort into this. And thank all those of you for joining. This webinar has been recorded and will be sent out to all participants so you can share this information with others within your organizations. It also gets posted to our YouTube channel so people can review them there. But thanks so much again, Curtis, and thank you all for participating today. We really appreciate your business and your trust with your borrowers. We couldn't do this without you, and we thank you all so much for it. Have a great rest of your day.